Good afternoon, everyone. Welcome to our Basics of Federal Excise Tax webinar. Our speaker today is Tim Reynolds. Tim is a CPA with Davidson, Holland, Whitesell and Company. And Tim also answers our federal excise tax hotline questions. So if you call the hotline, Tim is most likely the person that you're going to talk to about your questions on FET. I'm going to go ahead and mute everyone for the call, and then if you have questions at the end, go ahead and unmute and ask any questions that you might have of Tim at that time. So, Tim, why don't you go ahead and take it away?
All right, thanks, Gwen. It's always great to be here presenting another summer of everybody's favorite topic here, federal excise tax. I know it's a hot topic in the industry, and we've worked with several dealers across the United States with these issues, so I know it's out there. As Gwen mentioned, I'm a CPA here in Hickory, North Carolina office, which is, for those of you who don't know, Hickory is just outside of Charlotte. Here in North Carolina. I lead our retail manufacturing industry practices, which encompasses dealerships. And as Gwen mentioned, I also manage the FET hotline. So chances are, if you had a question, you've either got a phone call or an email back from me with an answer. So my contact information is there. I'll show that at the end of the screen too. So if you do have any questions after the webinar or presentation, feel free to give me a call or shoot me an email. I'll be glad to help you out. So got a lot of good information for you today. I'll go through the agenda real briefly. It's a basics class. Some of you may already know this, some of you may not, but I'm here to help you at least get a better grasp of it either way. So we'll talk about just kind of an overview of FET, kind of how it works, a little bit of history on it. We'll talk about some of the minimum requirements you got to kind of navigate through to determine if you have a taxable sale or not. We'll talk about parts and accessories, the suitable for use concept, and kind of a definition of just what is a first retail sale. We'll shift gears and go into some of the more common tax exempt sales. I won't cover all of them, but there are about 3 that are probably very, very common that you'll see in industry. And then we'll wrap up with just a kind of an overview of the Form 720, which is obviously the form that you'll use to report your sales, your tax, and the credits, and all that good stuff. And we'll talk about some of the rules around the payments and things of that nature. And should have some time for some Q&A. And again, if you don't get a chance to ask me something, my contact information will be at the end, and I'm always willing to give you a call back or an email. So with that, let's dive right in here. Kind of just a basic overview of FET. It's under Internal Revenue Code section 4051 through 4053. Not very big, not the cure for insomnia by no means, but it's out there. It's a retail tax, similar to kind of a sales tax that you're used to paying. So when you buy a truck, buy a trailer, if it's taxable, you're going to pay a percentage on top of that. So it's imposed on all qualified first retail sales of trucks, trailers, tractors, bodies, chassis, and also parts and accessories, unless they're exempt. And this is big, and I'll cover this a little bit more in detail later. If you sell a taxable unit, any parts or accessories sold within the first 6 months of that first retail sale are generally taxable. There are some exceptions, and we'll go into those here in a bit. The current rate is 12%. Hasn't changed for quite some time on the first retail sale of the trailer, unless it's exempt under some of the sections under 4053 and 4221, which I'll cover there towards the end as well. So very basics, probably familiar with these. FET was first enacted by Congress back in 1917, basically to help fund World War I. So it's a very, very old tax. It's been around for a long, long time. It started out under IRC 4061, which was a manufacturer's tax, but then it evolved into a retail tax shortly thereafter into IRC 4051. So it's kind of changed up, but still a lot of the same things under 4061 apply to 4051. As I stated, it's an old law. And as you can imagine, the truck, trailer, heavy duty industry has evolved 10 times, if not more over. So what happens is that leaves a lot of gray areas. It doesn't speak to a lot of things that are now in place, that are now in service. So what it does, it leaves a lot of gray areas that are subject to interpretation. In a lot of cases, it requires taxpayers to rely upon private letter rulings, the PLRs, the TAMs, tax advice memorandums, and some revenue rulings to really address, do I have a taxable sale or not? So you kind of have to draw from analogy to your facts and circumstances to say, you know what, maybe I have a taxable sale, maybe I don't. So, and again, that's just the nature of the playing field that we have to deal with. So a lot of things, if you went to section 4051 and looked up something, you're probably not going to see a specific line item that addresses your situation. So be careful with that. A lot of times it can lead you down the wrong path. So like I said, if you ever have a question, call the FET hotline. I can help you navigate through that. Retail excise tax, it's self-reported, self-assessed. As you can imagine, some taxpayers, some dealers read the same code and may come out with a different position that they may want to take, or may interpret it differently than another dealer down the street. So, and some outright just say, you know what, I want the sale and I'm going to take an aggressive position on this. I'm going to ignore the codes. I'm going to take on that risk in order to gain a competitive advantage. I would be very careful with that. Because taking the risk of not charging FET or taking an aggressive position can really get you in some hot water with the IRS. It can expose your dealership to some significant risk, not only in terms of FET, the tax, but penalties, interest, all that good stuff that comes along with that. And the thing is, if there's the statute's 3 years, but if the IRS detects fraud or willingness to flat out just ignore the code, they can go back as far as they want. So again, ultimate FET burden falls back to the seller. They're not going to go after your customer to ask for additional FET. They're going to come back to you for that tax. So make sure you understand that and be very, very careful when you're interpreting these laws. So before we deciding if the FET applies, there's a few initial questions that we have to look at, and I'll go through these in detail. But the first one out of the gate is pretty simple. What's the GVW? There are some certain requirements. Is the unit suitable for use with a weight that's less than GVW? Is there a specific design to the trailer that impacts the over the highway use? Is there a certain application that the trailer will be used for an exempt purpose? Has a first retail sale occurred prior to my sale? You get into a lot of that issues with imports. Is the sale tax-free or tax-exempt? Well, depending on who you're selling it to, it may be. And then this is an important one, is if the chassis is taxable, is the body and the attached equipment taxable? You may have a circumstance where the chassis is taxable, but the body may be exempt. So those are just some of the initial questions that you got to ask here. So the first one is the GVW. So it's very simple. FET is going to apply on the trailers if it's in excess of 26,000 pounds. So first in short, ask, is the trailer GVW over 26,000 pounds? If yes, you generally have a taxable unit. If no, you're generally okay. I'm not sure if any of you sell tractors. Some of the dealers we work with have both. But just wanted to throw this in here. FET will apply to tractors as well. So if it's a truck, you're looking at 19.5, semi-trailer, or if it's a Class 8 semi-tractor, if it can be combined with a semi-trailer in the excess of 33,000 pounds, it's going to be taxable as well. Again, I know that's the National Trailer Dealers Association, but thought I would throw in that information in case you do sell trucks as well. Parts and accessories, I talked about this earlier. Those are generally taxable if they're sold with or in connection with a new chassis, body, or tractor, or if they're subsequently installed within the 6 months of first retail sale. So that clock tick, it starts ticking as soon as title passes, the dealer, as you know, the customer has the unit and they're running it in service. That's when that generally starts. Those parts and accessories, they must be attached to the taxable body and contribute to the highway transportation function. And I'll talk about that here in a second, because that's very, very important when you're looking at parts and accessories to determine, are these taxable or not. Be careful with this. Even if you invoice those parts separately, they are still taxable if they're going on that unit. So don't try to skirt FET by just throwing it on a separate invoice. So again, make sure you know the 6-month rule. There is an exception. The IRS does give you a little bit of break on this. If the price of the parts and the end installation is less than $1,000 in aggregate during that 6-month period, there's no tax due. So they do give you a little bit of break there, but make sure you understand that's not on a per sale basis. That's $1,000 in aggregate. So if you spend $600 within 1 month and come back and put another 1,000, you've obviously tripped that $1,000 threshold, and that entire $1,600 will become taxable for FET. The highway transportation function. So when you're trying to determine if a part or accessory is taxable, you have to look at these 4 tests. So if that part or accessory contributes to the loading or the unloading of the unit function, the maintenance or safety of the unit, preservation of cargo, thinking of tarps is a good example, or the comfort or convenience of the driver or its passengers, probably more so with trucks, those are taxable. So loading and unloading, lift gates, maintenance or safety of the unit, that could be tarps as well. Could be for the safety of the cargo that you're hauling. Preservation of cargo, obviously a tarp. So there are a few explicit exemptions. So reefer units are exempt, and there's certain Qualcomm units, replacement parts, warranty parts, those are exempt. So you don't have to worry about those. There's no specific exemptions, there's no certificates, there's no anything like that. But if that part meets any of those 4 tests, you generally have a taxable sale, and FET is going to be due on it. Again, each item sold within that first 6 months should be reviewed. There are some parts and accessories that may not serve highway transportation functions. For instance, decals, they don't really help with loading, unloading, maintenance. So those can be exempt. But again, the important thing here is you got to review it on a piece-by-piece situation. So make sure you're doing that when you're selling to your parts and accessories counter, or your sales folks know how to navigate through that. The suitable for use concept is basically if the trailer is suitable for use with a lighter duty vehicle. So for instance, if you sell a trailer and it can be pulled by a pickup, as a probably extreme example, that's generally not going to be taxable for FET, because they're looking for things that are generally going to be meeting that 26,000 pound, 33,000 pound tests. So if it's something you could pull with a semi, with a truck or tractor, but if it can also be pulled with a pickup or something, or lighter duty vehicle, you generally don't have a taxable unit. There are some bodies that are exempt just by the mere fact of what they are, and I've listed them here. Again, if you're selling some of these, there's no exemption certificates. There's nothing you need to prove. So dump truck bodies, 8 cubic yards or less, dry freight, refrigerated van bodies, 24 feet less, refuse packer truck bodies, 20 cubic yards or less, and then the platform truck bodies, 21 feet or less. Those are exempt if you're throwing those bodies on something. So be aware of that. This is as you can imagine, this is a hotly contested area for the IRS. So be very, very careful with what you're telling your customers and reporting to the IRS as far as what is taxable and what is not. So just make sure you're able to substantiate why it's exempt for the IRS, why it's suitable for use with a lighter duty vehicle. And then this is very important, and I've seen this happen. The IRS, if they come in, they will look at your marketing materials. So make sure those don't contradict what you're selling and charging tax on or not charging tax on in case you ever get examined. So make sure those align with each other because they will come in and they'll ask for those materials and look at your website, and they'll make sure they cross all the T's and dot all the I's on it. The first retail sale basically occurs at the time the distributor or the dealer sells to the end user. Now that's under the assumption that a valid exemption certificate for resale has been provided to your manufacturer or your OEM. So I'm sure the OEMs are probably asking you for that as you buy trucks or trailers for resale. So make sure you're giving that to them. So under that assumption, the seller, which is the distributor dealer, will then be required to charge, collect, remit any applicable FET on the sale. And again, very, very similar to how state tax is administered. You're just the trustee of the government, but it's upon you to make sure you're calculating the right tax, making sure you're charging it, making sure you're collecting it and remitting it timely. Be careful here though, because the first retail sale is not only that first sale from the dealer to the end user. FET could apply in a couple situations. So let's say if you bought some stock trailers and you say, gosh, I need to use one of these to go down the road and pick up something. Well, you've basically tripped FET at that point. So using that unit before its sale, you're on the hook for FET. If you lease or rent that unit before an ultimate sale, you're on the hook for FET. So be very, very careful with that. Sometimes if you import a unit, if it hasn't been subject to a first retail sale in the United States before it left to go to, say, Canada, and it comes back, you have to pay FET on that, whether you use it in your own business or if you resell that. So very, very important, the concept there. And I get a lot of questions on the FET hotline about this sometimes as well. And then if you have improper documentation of an exemption certificate, and I'll show you those here in a second, but if you don't, like I said, cross those T's, dot those I's, the IRS can play hardball with you and throw that out if you don't have it properly executed or filled out. So make sure you're aware of that. All right, so shifting to some of the tax-free and tax-exempt sales. The exemptions under IRC 4221 basically are based on the identity of the purchaser or how the customer is going to use the unit. So I've listed them here. The first three are the most common, and I'll cover those in the most depth, but simple sale for resale. So if you're going to buy some units from the manufacturer and resell them to end consumers, that's pretty easy. If you're going to export, get a lot of questions about export on the FET hotline. So if you're exporting trailers to Canada or Mexico or somewhere else, there's some things you need to be aware of and collect and get in your deal file to make those exempt. State or local governments, I'm sure though some of you on here have those. There's also further manufacturer, which are kind of few and far between. And then there's nonprofit education institutions and qualified blood collectors. But again, the first three are the most common. I'll cover those in most depth here. The first one is a sale for resale. So obviously, OEM manufacturer sells to the dealer for the resale. You also get into this when you have dealer to dealer sales. So if I'm a dealer and you come to me and you're a dealer, obviously you say, hey, Tim, I've got a sale here. I got a customer here that wants 2 of the trailers. You have them on your lot. Can you sell them to me and I'll resell them? Sure, yeah. So in order for that sale to be exempt from me to you, I need to collect a sale for resale certificate. So just saying, hey, dealer, your dealer, Tim's sale to you is going to be exempt and you're going to ultimately sell it to the customer. So we need to make sure to get those in the deal file, because if you don't, IRS will come back to me and say, well, Tim, why did you sell that trailer to the dealer down the street? Well, they were sale for resale. Well, do you have a resale certificate? No. Well, that becomes a taxable sale, and guess who's on the hook for the tax? Me. So be very, very careful when you're doing dealer to dealer sales. Um, on the tax exempt sales certificate, the purchaser must provide basically some information stating that, certifying that she or he is purchasing it for resale, must be completed, signed, dated. And be very careful here too. The certificate must be signed and dated on or before the sale date. So if you sell something on July 1 and I come in and look at your files and you have an exempt certificate dated 7 or July 8th, that tells me you didn't have it at the time of sale. So the IRS will look at that and they'll want to see that that was dated July 1 or before, just to show that you did do all the right things and have a properly executed exemption certificate in your deal file. Because if you don't, like I said, they can be sticklers on that and they can throw it out. Purchaser must sign it, in good faith. The seller must accept it in good faith, meaning that, hey, I know who this person is. I know they've executed. I asked for all the right things, and we're good to go. So this is what it looks like. Many of you probably have these, I've seen it a million times. But one thing I want to point out here is, at the top it shows who you are, your title, what you're doing. And then if you're selling just like on a one-off sale to a customer that you probably won't ever work with again or whatever it might be, you can check that first box just to say, hey, we're selling this unit, tax exempt, you want to resell it. But if you're selling to somebody that is going to buy one or more units over a period of time, let's say you sell to a fleet, maybe X amount of trailers a month or a year, you can check that second box, and it's called a blanket certificate. And basically what will happen is this blanket certificate is good for 12 calendar quarters, okay? It's good for 3 years. The thing you have to understand here and be careful of is these do expire, and you're going to need to monitor those expiration dates. So as part of your monthly accounting close, you might have somebody look at those exemption certificates and just make sure that they haven't expired. And if they do, that's okay. You'll want to you probably want to look at it before they expire, a month or so, and then go back to your customer and say, hey, you got an exemption certificate with it's going to be expiring here in a month or two. Can you get me a new one? Just good accounting practice just to have that and be a little proactive on it. Sign it, address, keep that in a deal file, and you can sell exempt all day long. So that's the sale for resale. Again, IRS is very strict. Double check those dates. The blanket sales are only good for 12 calendar quarters. The Form 637 registration, I'll go back to this. You see I have that highlighted there. Most of you probably have Form 637 number. It's basically your Q number. But years ago, the IRS relaxed this on simple sales for resale. So you don't really have to have this, but it's okay to have it. It's okay not to, but some of your OEMs may still require that. And if they do, that's fine. Just throw it in there, but just know that they don't generally require that on a simple sale for resale anymore. But that's kind of dependent upon the OEM sometimes. And again, keep a copy of that executed sale for resale certificate in your deal file to support that sale. I cannot stress that enough, because if you sell something today, and let's say you get examined or audited in 2 or 3 years from now, you go back to that deal file on an exempt sale and you don't have it, what are you going to do? Well, it's going to be hard to prove that to the IRS that you had it. You might say, well, gosh, I did have it, it's just lost or something. But that could be a little troublesome if you don't have that. So get it in the deal file, make it part of your closing checklist before you hand over the keys or have any of that trailer pulled off the lot. Make sure that's in there. Sale for export, these are very common between United States, Canada, United States, Mexico. They can qualify for tax-free status. The seller sells directly to the end consumer or exports the item for second export. So like a broker that you need to sell to. There's no prescribed exemption certificate for a sale for resale or for a sale for export. Rather, it's really a proof of exportation. So basically, if I sell to a customer in Canada, I can sell that to them exempt all day. But what I'm going to need to get in the deal file, and this is very, very important, I'm going to want to get that in my deal file within 6 months of the sale date or shipment date, whichever is earlier. So again, very important that you be looking at the dates of sale, dates of exportation documentation to make sure that's all within that 6 month period. Because if there isn't any proof of exportation, or if there's documents that have bad dates on them, that sale becomes taxable. And guess who's on the hook for the tax? Me, the seller. So when you're selling to uh, parties for export, make sure you're getting that documentation. So the next question, okay, Tim, what can I get in the file to support this? Well, copy of the export bill of lading issued by the delivering carrier is probably the most common, most easy thing you can get. There's also certificates you can get from the agent or the representative from the export carrier. Basically shows that VIN number was exported. You're good to go. Here's the date. Some kind of certificate of lading signed by a customs officer or the foreign country. A foreign consignee shows it was received, and that's only if obviously the foreign country doesn't have really a customs department or administration. So um, in rare cases, if none of those are available, which I find it hard to believe, but I'm sure there is, some kind of statement or certification by some kind of authorized office or department of agency of that foreign government or agent administration, basically on their stationery, just stating the unit, the VIN number, the dates, all that was exported. That should suffice as well. Sales to state or local governments. I'm sure this is a common one for some of you, selling to a city or state. Those are exempt. However, sales to the US government are not explicitly exempt. I know it sounds weird, but you're basically charging the federal government their own federal tax. It's left pocket, right pocket. I know it, but those are the rules. However, if it's a state or local government, a city, a county, state, obviously, they can be exempt. They don't generally register with the IRS. So what happens is you have a prescribed exemption certificate, similar to the sale for resale certificate, that you're going to need to get for your files. That's signed by an authorized officer or employee, and a purchase order that contains all the necessary information contained in an exemption certificate, just in case they need to self-assess the FET. And here's what that looks like. Very similar to the sale for resale certificate. And if anybody needs these certificates or like a copy of them, I can, hopefully you have them, but I can send those out. Just shoot me an email after the presentation. I'll get those to you. But again, similar to the sale for resale certificate, basically tells you who the title of the officer of the city or state or local government, whoever they are. And again, similar to the sale for resale, if it's a one-off thing, you'll never do it again. Just they can check the first box. It's just a one, you'll never have this again. But if you sell to a city or county or state where you sell multiple units per year, I'm over here, or things of that nature, you can get a blanket certificate, and those will cover those 12 calendar quarters. Again, you got to be very, very careful with monitoring expiration dates to make sure that those are valid. They're still good. They still support your exempt sales. And again, you'll want to make sure during your monthly accounting close, you'll want to monitor those to make sure you've got them on file. Sign it, date it, address, all that good stuff, and you're good to go. You can sell it to the city of XYZ or state, whatever, all day long. Sales for further manufacture. These, I don't see a whole lot of these. I probably see them more in the trucking industry, basically for trucks that are going to get sold, and then they're going to remanufacture them or put a body on it or change their transportation unit or function in a way that they come out with an entirely different unit. So if you think of wireline units for the oil and gas industry going down to Texas or something. They'll take a chassis of a truck, and then they'll basically reinforce it, kind of beef it up a little bit because of the equipment they put on that is very, very heavy. So that would be a good example of a further manufactured trailers. I'm not sure what they would do with those, maybe put some kind of stationary unit on it, or make a water purification trailer out of it or something like that. That might be something that they do. But again, these are few and far between, at least from what I see or deal with in industry. But basically, the purchaser buys the truck or trailer from you, and then they're going to take that, further manufacture it, modify it, and then resell it to a customer. So similar to a sale for resale certificate, but this is just, hey, I'm going to sell it to another entity, but I'm going to remanufacture it to a point where it's an entirely different unit. So again, there's the rules on that. Again, you got another 6-month rule to kind of get some documentation together. There's the acceptable forms of proof. Basically includes some a certificate, which I'll show you here in a minute. But again, dated, basically tells that the undersigned buyer is going to basically take this article, remanufacture it, resell it, and there's some language there to navigate through, and then signature, address, and you're good to go. Sales to not-for-profit educational organizations, so schools. Again, this must be for the exclusive use of the organization. So if you know that they're going to take it and resell it, you're probably not going to want to do that, because that avoids that exempt sale. Must be sold directly to the organization. They will have their own, these universities or these schools, they will have their own Form 637 registration number. It will begin with an F. So make sure you're putting that on the invoice, because again, there's no specific exemption form. Rather, you'll just put that registration number on the invoice reference to say, hey, I sold it to XYZ University, exempt. They gave me their F number, put that on the invoice, keep that in the deal file, obviously, and you shouldn't have any problems. Sales to a qualified blood collector, those, if they're organized under these chapters in the IRS 501c3, 501a, if they collect blood as their primary activity, they'll have their own Form 637 registration number as well. And again, it'll start with a BC, and you'll just put that on the invoice to show that you sold to a qualifying blood collecting organization. It'll show that they're registered, and then by the FDA. And again, that unit must be for the exclusive use of that organization. So very important information to have there. There's a few other additional exempt organizations, sales to the Red Cross, United Nations. Those are considered tax-free sales, just by who they are. So nothing really to put on the invoice. I think just having that information as to who they are on the invoice, their name. They will not have a Form 637 registration number, I do not believe. So you should be okay there just by listing who they are. A couple other exemptions under 4053 that I'll talk about real quick. These are more for bodies, and some are trucks, some are trailers, some are both, I guess. But there's 10. And obviously the first one is a camper coach body, self-propelled mobile homes. Those are exempt. Number 2 here is very, very important. And it's one I see a lot of dealers get tripped up on. And farmers are great people. They're awesome. But they think they're exempt on everything. And sometimes they are. But the bodies for the exemption have to be primarily designed for these functions. So if it's a feed, seed, or fertilizer equipment, and there are some specific bodies that are designed just to haul that stuff, those are exempt. But if you sell just a regular trailer that's going to be put on a farm or used on a farm, those are generally not exempt. It's not really how you're going to use it, it's how it's designed. That's what you got to look to. So, and again, I alluded to this earlier, the IRS will look at your marketing materials. So if you have bodies that you sell that are specifically designed um, that are for these three purposes, and your marketing materials support that, you're okay. But if you sell something exempt, like a regular uh, flatbed or as a regular trailer that you can haul feed in on Monday, gravel on Tuesday, mulch on Wednesday, and whatever on Thursday, that's a problem. That's not primarily designed for a feed, seed, and fertilizer function. So that would trip the primary design clause or language, and you would have a taxable unit. So again, be very, very careful. Sometimes you might have to explain that a little bit to a farmer who's across your counter, demanding that he's exempt on everything. House trailers, ambulance, concrete mixers, trash containers, pretty self-explanatory. Those are all exempt. Rail trailers, rail vans, designed for a highway vehicle and a railroad car, those are exempt. Mobile machinery is another big one. And this will be covered in I think the August or September presentation, because this is a very big area. But mobile machinery, so if it's permanently mounted and it's specifically designed, that trailer is specifically designed really just to carry that only, generally those bodies are exempt. For instance, a crane that might go on the back of a flatbed trailer, it's designed to be the power source, or actually the carriage, and there's a power source on it for the crane. Those are generally exempt all day. But if you have a crane, and if it has any kind of cargo carrying capacity, so if it has a crane, but you can put 20 pallets of something else on it, that's going to be a problem because it has cargo carrying capacity. That is not permanently or specially designed as a carriage only. You can now haul pallets of bricks or whatever it might be. So be very, very careful with that. But if all that body does is designed to haul that crane and that's it, you're good to go. Idling reduction devices, those are for trucks, obviously, and then any kind of advanced insulation, not less than R35, is exempt. There are no special registrations for these, no certificates. Just know that they can be exempt. Most of these items, obviously, a cement mixer, things of that nature, can be pretty easily and readily identified. However, in some cases, going back to the farm feed and seed example, and even the mobile machinery example, those can be hotly contested. And if you're selling those types of things exempt, be ready to defend your position, because the IRS will place a lot of scrutiny on those sales of those types of bodies, just because there's some gray areas there and a lot of subjectivity in how you interpret it as well. All right, on to Form 720. So this is where you report your quarterly FET. So obviously it's the retail tax on trucks, trailers, semi-trailer, chassis, bodies, all that good stuff. It's a quarterly form due, the first quarter, obviously the January through March is going to be April 30th and so on. So obviously the fourth quarter will be the following year, January 31. So again, pretty simple, quarterly reform, summarizing all your sales. There's three main sections to it. FET is reported in Part 1. It's under IRS number 33, basically where you'll enter the 12% FET charged on your retail sales. From there, you'll bring in any tire tax credits that are that come over from Schedule C, line 15A, and just tire tax credits are could be a little bit of a troublesome area for some. I've been asked a million times, do you have a tire sheet? And I don't. I think at one point in time there was tire sheets going around that basically showed the tax per tire. I think generally anymore it's like $25 and 30 some cents, I think, per tire. It's a standard tire. If you do have a specialty tire, something that's oversized or whatever it might be, just call the tire manufacturer and ask them what the manufacturer's excise tax was on the tire, and they'll tell you. And then that'll be what you use for your credit. keep that documentation in your deal file too, and your Form 720, because if it's outside of the $25, you're probably going to want to support that. Deposits, you'll basically reconcile those. They'll bring them over from Schedule A, Section 1, for each bi-monthly deposit, and then plus a special September deposit, which I'll cover here in a second. So bringing that all together, face of your Form 720, line 3, you'll report your tax. Line 4, you'll deduct your credits. Line 5, you'll bring in your deposits you've made, and then you'll end up with a balance due or an overpayment, depending on how everything falls. Those deposits are due bi-monthly, so you'll use the EFTPS system. Do not mail a check. They will not accept that anymore, and you'll get in some trouble because they'll probably throw it back at you. They will not take that, as far as I know. So EFTPS, make sure you're registered for that. Sales that run from day 1 through day 15 of a given month, you'll tally those up. You'll make your deposits, and those that payment is due no later than the 29th of the month. So that'll be your first deposit. And then sales that run from the 16th of the month to the end of the month, that payment is due no later than the 14th of the following month. So your bi-monthly deposits will kind of overlap into another period, but those are the kind of the timing on the sales and then deposits. If that payment's due on a federal holiday or weekend, make sure you make that payment prior to the due date. The other thing to be careful of is those payments must be at least 95% of the actual liability. So don't try to shortchange it to say, oh, gosh, I'll just pay 50% of the first month or the first payment, and I'll true it up with the last payment that's due on the 14th. Don't do that, because what will happen is IRS will see that when you file your Form 720, and they'll go, hey, you didn't give us your money on time or didn't give us enough. So they'll ding you with probably interest and penalty on it. So it'll cost you a little bit more. I talked about the September deposit rule. Just know that there's 2 payments made for that second monthly payment. I think this is due to how the federal government ends their fiscal year in September. So they want to make sure they get all that money in sometime in September to help with the closing of the books. So that second September payment that covers September 16th to the 26th, that's due on the 29th. So you only get 3 days there instead of the 14th. However, sales that cover September 27th through 30th, you're back on the regular payment date with the 14th. So it's kind of weird. They try to front load those last 10 days with the 29th deposit, and then they say, well, the remaining 3 days, just give it to us on the 14th. So just be very, very mindful of that, because if you don't follow those rules, again, you can be subject to some interest and penalty on underpayment. So for the up-to-date reference information on when those payments are due, just take a look at publication 509. It'll tell you the holidays, the payment schedules for the coming year. Mark those in your calendar. Make sure you're following those. So that is pretty much all I had for today. Again, it's basics, very high level. We'll get into some of the more detailed tax issues in the next 3, over the course of the next 3 webinars. Some that might be more specific to you guys, depending on what you're selling. But again, those are the basics. That is my contact information there. Feel free to give me a call, shoot me an email. The next session will be July 19th, same time, same day, Tuesday. And we'll cover FET best practices, and that'll be just kind of a summary of things that I've seen dealers do really well and do really bad, and help you navigate through how to avoid those mistakes, and basically navigate through a federal excise tax exam. So thank you very much. I think we have some time left here, so I will, Gwen, if you wanted to unmute or do whatever you need to do, I'll be glad to answer any questions.
Just so everyone, Yeah, just so everybody knows, Tim, we will post the recording from today's session out on the website under the member section. So I can also send you a copy of the PowerPoint. I can get that from Tim. But also feel free to contact Tim directly if you have questions. Also thought I'd mention Tim will be speaking at the NTDA convention in the fall in October. So he'll be covering federal excise tax, any updates, and also going over best practices also during the convention. So if that's something that you're interested in, you can register on our website. Go to www.ntda.org. And then it's the third tab over is the convention tab. And then it's the first link underneath that to register online. Or if you need information, feel free to shoot me an email or give me a call. If anyone has a question for Tim, feel free to unmute yourself and fire away with your questions.
Yeah, and if anybody has, if you want the slides, I can send those to you directly. So feel free to email me. The other thing I mentioned is if anybody wants a copy of those exemption certificates, I'm more than happy to supply those to you as well. So just like I said, give me an email and I'll usually pretty good about returning things pretty quickly.
All right, great. Well, if there aren't any other questions, then we'll go ahead and end today's session. All right, everybody have a great first day of summer and a good rest of your week.
All right. Thank you.
Thanks, Tim.
Thank you.